Is 2026 housing market in a crash, a boom, or what I'm calling the gray stall? In this update, I'm walking through where the best investment markets have shifted, which areas are winning and losing on a 1 year and 5 year appreciation, what the new vacancy and rent data actually says, inflation, labor, tariffs, why new home sales just collapsed, what the great stall means for you, and then I'll dial it down to Spokane and Coeur d'Alene. Plus, I'm going to toss in the hottest and coldest sales markets with a new major investor opportunity coming out of, guess what? None other than HOA reform. Let's jump into it, everyone. Let's start with the current best markets for investors. And my March 30 baseline, the five headliners were Indianapolis, Atlanta, Charlotte, Jacksonville, and Memphis. Since then, all five have deteriorated. And in Indianapolis, inventory is up 27% year over year. Its PwC institutional ranking has dropped 10 spots, and list prices are now slightly negative, about just less than 1%, so 0.8%. And that's cooling fast, so it's going to only get worse there. Charlotte inventory is up 25.3% year over year. Prices are flat, and its hotness rank is falling. Jacksonville list prices are down 2.3, rents are down 4.2, and it's Zillow, but still Zillow has its at number one market for first-time home buyers. So investors have to thread that needle, pretty tightly there. Memphis list prices are down about 10.3% year over year, and that is one of the weakest markets nationally. The rotation is the big story, ranking from NAR, Zillow, Realtor.com, PwC, all confirm that the center of gravity for investors right now has shifted to the Northeast and Midwest. Think Hartford, Rochester, Worcester, Toledo, Providence, Richmond, Grand Rapids, Milwaukee, New Haven, Pittsburgh, all of which we've talked about in the past. Outside of Grand Rapids, it's the first time Michigan's hit this good list. Uh, these are all places with accessible prices and real sales plus price growth, right? Not just one or the other. So they're getting both sales growth and price growth. Takeaway: the 2020 and 2023 Sun Belt and the run-up darlings are they're all losing steam, and they're the more boring, supply-constrained Midwest and Northeast metros are now where the numbers actually pencil best. Now, next, appreciation, both 1 year and 5 year. Nationally, the FH and FA, or the FHFA, shows home prices are actually up about 1.8% year over year. In Q4 2025, the slowest pace since 2012. The 9 states plus DC are actually negative. And Florida is the worst state out of them all at negative 2.7%. On the 1 year leaderboard, some of the top metros include Reading, Pennsylvania at 8%. It's at actually 8.3% for the 1 year. It's at 62% for the 5 year. Mount Pleasant in Wisconsin, that's at 8% for the 1 year as well. It's at 58% appreciation for 5 years. Syracuse, New York, that is up as well, 8.01% for the 1 year, and it's nearly at 69% over 5 years. That's great appreciation. Good for you guys in Syracuse. What you're going to see in metros like New London, Connecticut, Youngstown and Warren, Ohio, Chicago, Atlantic City, with these are all healthy mid single digit 1 year gains with massive 5 year run ups. On the large metro side, you're looking at Boston, Richmond, Columbus, Jacksonville, Miami, Phoenix, Denver, Dallas, and Orlando. They're all in the mix with the modest 1 year growth, but big 5 year numbers. On the worst end of it, we're looking at Cape Coral and Fort Myers, Florida. Florida gets hit a lot in these numbers, and it's the standout at negative 9.1 appreciation. has the sharpest correction among the 100 largest metros. The investor takeaway is simple. The 1 year winners are mostly small to mid-sized Midwest and Northeast metros, where the supply is structurally tight and the prices are still accessible, while a lot of the 5 year Sunbelt heroes, so to speak, are either flat or they're giving back gains. Vacancy and rents tell a very interesting story right now as well. The consensus data shows the Q4 2025 national rental vacancy rate at 7.2%, the highest since 2017. Apartment List has at 7.3%, a record high in their index, while broader measures like Yardi put apartments closer to 8.5%, and luxury Class A vacancies push above 11%. That's the highest since they've been keeping track. Regionally, for rentals in Q4 2025, you got in the South, you got a 9% vacancy rate. You have in the Midwest, you have 7.2%. In the West, you got 5.5%. In the Northeast, you got 5.2%. And that's still a very supply constrained market. At the same time, you've now had 30 straight months over year rental declines. And in the big metros, where the national median asking rate is actually down 0.1 or 1.7% year over year, and about 5.5% below the 2022 peak. Even though rents are still 19% above pre-pandemic levels, concessions are at a 12-year high at 16.6% of stabilized apartments and the stabilized apartments are now offering concessions averaging about 10.7% discount. That's about 5 weeks free on average. That's massive. So, big picture vacancy is high. Rent growth is negative. But because supply is now slowing, the prediction is for vacancy to stabilize into the high sixes and high 6% range as we go through 2026. So that's good. So it's going to come back down. As an investor, that means underwriting some softness and concessions now, but also recognizing this isn't a 2009 style vacancy blowout. Let's hit inflation quickly. The March CPI came in hot at 3.3% year over year. That is up 2.4% from February with a huge 0.9% monthly jump. That move was almost entirely energy driven. Gasoline is up 22.2% month over month and 18.9% year over year, with the national average hitting about 4.12 cents a gallon for the first time and this is the first time it's been over $4 since the Russia-Ukraine spike. The important nuisance about all this, right, the core CPI, this is including food and energy, is at 2.6% year over year, with a very mild 0.2% month over month, which actually came in below expectations. So the Fed is still uncomfortable, but it is an energy shock more than a broad one way of inflation shock for real estate and for real estate. That means that mortgage relief is slower and choppier. It's not dead. So don't give up on it, but it ain't gonna happen soon. So don't expect any kind of mortgage cuts in 2026. On the labor side, the headlines look okay, but the details are actually weaker. March non-farm payrolls printed 178,000 jobs added, but about 54,000 of those were just doctors' offices unwinding a strike, basically reversing delayed February losses. When you strip that out, organic job creation is actually far weaker, with the 3-month average running about 68,000 jobs per month, which is well below the roughly 150,000 needed to just keep unemployment from drifting up, right? So we are definitely continuing to increase month over month on how much people are on unemployment. Unemployment is at 4.3% long term. Unemployment is for 27 plus weeks, right? That is up 300,000 people year over year. And federal government employment is down about 355,000 jobs from its peak in late 2024. Fed Chair Powell literally said job creation has virtually come to a halt. So again, it's not a total collapse, but definitely not booming wage and job story that would support another big price leg up. It's consistent with a slow growth, cautious consumers, and buyers being extremely payment sensitive. Tariffs. Now tariffs and construction costs. This is where the real headwind for builders and rehabbers are coming in. Now, year over year, we're looking at 25% on copper and copper products, 21% on steel mill products, and effective tariffs on Canadian softwood lumber now 35% plus a 10% Section 232 tariff. Kitchen cabinets and vanities at 25% locked in through 2027. And steel and aluminum are now facing 50% Section 232 tariffs. Oof. NAHB estimates that tariffs alone are adding about $10,900 per home in cost. And Cushman and Wakefield pegs materials cost at 6% versus 2024, with a total project cost up about 3%. Building materials overall are up 40% since December 2020. We've also lost about 60,000 home construction jobs since late 2024. Massive. So for flips, burrs, ground up construction, that means you should be baking in about 6 to 10% above your pre-tariff cost assumption just for materials. And being honest, it's all about timelines and risk. So how fast can you get this thing done? And make sure you're building these contingencies, and these are protect you. You get a loan on it, these lenders are still going to cover it, right? If the real cost is $1,000, you're holding back $2,000 just in case for inflation. Well, you're doing good. All right, new home sales have rolled over hard. The latest available census data is delayed because the government shutdown. You gotta love the lazy government politicians, right? We are all here working, they get to go home on vacation. Some in Disneyland. This all shows January 2026 new home sales at 58,000, which is down 7.6% month over month, and 11.3% year over year. So it's down 11.3%. Supply is sitting at 9.7 months. That's the highest since 2009, and completed homes for sale are at 126,000. Also, the highest since the last cycle's burst. Median home prices are about 400,000, which are down about 6.8% year over year, and roughly a third of builders are cutting prices around 6%, with about 2/3 offering incentives instead. So in the new construction world, builders are clearly blinking first. They're cutting prices, they're juicing incentives, they're slowing permits, which are down also around 5.6 or 5 to 6% year over year on the latest read. For investors, that sets less future competition for new product, but more near-term pressure on resale sellers, and for those of you who have, try to compete with builder concessions. Let's put this all together, and you get what this whole report calls the Great Stall. Existing home sales in March 2026 dropped to 3.9 million, breaking below the 4 million psychological floor. for the first time in over 3 years. That's down 3.6% month over month and down 1% year over year. Inventory is up slightly at to 1.3% or 1.36 million, if I can get it out. That's units, and supplied monthly supply is at 4.1. The While the median existing home price hit a record 408,000, that's up 1.4% year over year. Days on market improved from 47 days in February to 41 days in March, but more than 52% of those listings are also sitting for 60 plus days on market, the highest share since 2019. Investor share of those purchases also climbed up to 18%, and that's up from 15% a year ago. So even as the volume shrank, so what do we have? We have sales volume down, inventory up modestly, but it's still below 2017 and 2019 norms. Prices are they're still rising in most areas. Investors are taking a bigger slice of a smaller pie. That's exactly what a stall looks like. A frozen move-up sellers, cautious owner-occupant borrowers, and investors quietly picking off all the best deals while everybody else waits for that clarity that never arrives all at once. I know I have several friends and family that are holding on until rates drop. They're holding on until this happens. They're holding on until that happens. But there's so many things that fall into it, right? Real estate is a game where you jump into it and wait for everything to change to either refinance or sell. Your strategy can be created and adjusted. When we can create that strategy, I'm great at strategy. So call me, text me, email me. We could talk about it. Now let's zoom into Spokane and Coeur d'Alene. For Spokane and Metro median, for Spokane, the Metro median sold price is around 410,000, roughly 68% above the 2019 baseline, but currently down about 1% year over year, basically flat and slightly down, right? Months of supply is about 3 to 3.5 months, and median days on market is about right about 40 days. So that's slightly a little bit faster than nationwide. So that's awesome. Delinquency is about is low, and that is about 0.7% versus the 1% nationally. On the rental side, average 2-bedroom rents are $1,400. With an overall rental vacancy around 7.2%, and apartments had recently peaked around 8.5% vacancy. So before starting to compress again as new supply slows, multi-family permits at the city level dropped 54% in 2025. That's from about 1,010 units to 460 units. After more than 3,600 units were delivered over the past 2 years, that's also the single most bullish data for Spokane apartments over the next 1 to 3 years. Coeur d'Alene is more of an appreciation story. Prices are around 600,000, massive, with 3 to 4.6% year-over-year growth and only 2.3 months of supply. Active listings are down 17% year over year, and homes are selling roughly 30% faster than a year ago. Kootenai County's population is growing about 1.8% per year, over 3 times Spokane County, and CDA is Idaho's #1 job growth metro. So, simple framework. Spokane equals cash flow and value add, with improving vacancy and good entry prices. It's cheaper for the people to get into. Can you afford, 380, 400 grand, or can you afford 600,000? If you can afford 600 grand, good for you. Let's talk. I'd like to talk to you. But When it comes to CDA, it equals tight supply, stronger appreciation with thinner initial cash flow, but a strong long-term demand. Nationally, the hottest and coldest sales markets line up with everything we've already talked about. On the hottest side, in March 2026, it all reports, multiple of these agencies are reporting, put Springfield, Massachusetts in the number one spot for sales activity. It's 3.6 times the national average of views per home. Home selling in 32 days, and median list price around 352,000. Affordability, you see that number there, 352, 600 grand. More people are going to buy at 352 than are going to 600 grand. That's why they're moving faster. Affordability played just outside, much more expensive Boston too. Location. So you got to look at that location. Location's a boom for Boston is a booming area right now. Okay, well, why don't you go just outside of it, sell stuff for cheaper? Makes sense. Midwest and Northeast markets have held all of the 20 hottest spots for 30 straight months. I've been pounding Midwest and Northeast, right? Not the Sun Belt, Midwest, Northeast. All are holding the 30, holding the hottest spots for 30 straight months. On the coldest side, markets like Memphis, Austin, Phoenix, San Antonio, and parts of Florida like Cape Coral and Fort Myers show steep price cuts, elevated price reduction, shares, and rising inventory. For example, Memphis is down 10.3% on list price. Austin is down 7.9%, with over 20% of the listings reduced. And Phoenix has nearly 30% of the listings with price cuts. Sunbelt investors are seeing classic overbuild hangover conditions. Too much construction, lots of supply, and motivated sellers, while the Northeast and Midwest are seeing the best mix of demand, speed, and pricing power. Last piece I want to jump into, and this is huge for investors who touch condos and townhomes. In Georgia, the Georgia Property Owners Bill Act of SB 406 is posed to become the most comprehensive HOA oversight law in the state's history. It's passed both chambers overwhelmingly, and if signed, will take effect January 1st, 2027. It forces HOAs to register annually with the state, doubles the foreclosure threshold from 2,000 to 4,000, and at least 1 year in the rears. It bans HOAs it bans HOAs and their insiders from bidding at their own foreclosure auctions. It requires open books and a decade-long record retention, and creates a low-cost state dispute process, right? So you want to dispute your foreclosures. Nationally, similar reforms are rolling across. You got Florida, Texas, California, Colorado, Arizona, Montana, Minnesota, and others, including fine caps, audit requirements, transparency websites, extended foreclosure timelines, and strict rules around selective enforcement. At the same time, Fannie and Freddie have eliminated the 50% investor concentration cap on condos. Effective, and that's effective actually March 18th of 2026, this year, which suddenly makes many previously non-warrantable buildings financeable again with conventional loans. That is typically at lower rates than DSCR or non-QM. And even in the investment real estates, non-warrantable is impossible to get financing. I guess I wouldn't say impossible, but extremely difficult. Non-warrantable is hard. So that's awesome. Good for Fannie and Freddie making the right decision. So for investors, that means this. 4 points. More predictable HOA expenses feeding into DSCR calculations. Far better transparency on reserves and litigation before you buy. Less catastrophic risk, legal risk in disputes. And a wider conventional financing access for investors on investor-heavy buildings. In other words, the condos and townhouse space, which many investors have avoided for years, is quietly becoming more investable as the rules finally catch up with, guess what? Reality. If you want help tuning all this data into actual deals, and from DSCR on rentals and small family to fix and flip and bridge refinancing, especially here in Spokane and Coeur d'Alene, reach out. We can underwrite your deals with realistic vacancy, rent growth, and construction cost assumptions, and position you for this great stall environment where patient, well-financed investors quietly pick up the best assets. Let me help. Let me help you be that person. If you guys have any questions, please get a hold of me. Email me, text me. Phone number is 208-215-9936. My email is rhopenlanefunding@outlook.com. Thank you, everyone, and have a fantastic week.